In Financial Accounting, Chapter 2, we will be discussing how to measure business transactions. The objectives of Chapter 2 are to explain the generally accepted ways to solve the measurement issues relating to recognition, valuation, and classification, to describe the chart of accounts and commonly used accounts, to discuss and define the double entry accounting system and state the rules for double entry accounting, apply the steps of transaction analysis and processing to various simple transactions. Fifth will be to prepare a trial balance and describe the values and limitations of a trial balance. And two additional objectives will be to record transactions in the journal and then post transactions from the journal to the ledger. Let's start with objective number 1, to explain the generally accepted ways of solving the measurement issues relating to recognition, valuation, and classification. Are economic events that affect the financial position of a business entity. We must address several questions when trying to determine if an actual transaction has occurred. First, we must look at when did the transaction occur. Should we recognize it because an economic event has taken place? Example, a sale. We say that a sale is recognized when title passes from the seller to the buyer. You can read more about this on page 92 in your textbook. But let's explore this question in more detail with regard to the sale. Let's start with, for example, a desk. Let's say our company decides to order a desk. How does this whole process unravel? First, somebody within the company sends a purchase requisition to the purchasing department within our company. That's step number 1. Step number 2, somebody in the purchasing department sends what's called a purchase order to a supplier or seller of that desk. Step number 3, the supplier or seller of the desk ships the desk to us. Step number 4, our company receives the desk. Step number 5, our company receives the bill for that desk. Sometimes step number 4 and step number 5 occur simultaneously. So we may receive the desk at the same time that we receive the bill for the desk. Step number 6 is our company pays the bill for that desk. So a question is, when do we record that an economic transaction has occurred that affects our financial position? For most of us, that step is going to be either between step number 3, the supplier ships the desk, or step number 4, our company receives the desk. That's going to be determined whether it's 3 or 4, depending upon what the shipping terms were that the two companies agreed to. Did they agree to terms where we say that title passes at the shipping point, so when the seller shipped the desk, or the title passes at the destination point, meaning title passed when the buyer receives the desk. For simplicity purposes, though, some small businesses might not record that an economic event took place until steps 5 or 6, when the company received the desk or when the company paid the bill. So you can see how that recognition question becomes very important, and it will depend upon each company and what they have determined is their best method of recording the recognition issue. The one big thing with regard to recognition is they typically, the business itself has to be consistent. And like I said before, most businesses are going to record it at either step 3 or step 4, depending upon what the shipping terms were. The second question in the measurement issues are valuation. What is the monetary value that should be recorded for that transaction? We're using dollar values. We use a dollar value to record the transaction. And typically we use what is called the cost principle. We record transactions at their historical cost, the acquisition cost. This is the exchange price for that transaction. So in our desk example, whatever the exchange price that was agreed upon between the seller and buyer, that would be what we record that transaction at. One of the primary reasons that we record transactions at cost is that cost is always verifiable. Cost does not change. There are exceptions to recording transactions at cost. Sometimes transactions such as investments are recorded on the financial statements at their market value. That is because marketable securities, the valuation of them changes so quickly. The next question becomes classification. Which accounts are affected by a transaction? We maintain a chart of accounts to choose from for each type of transaction. What accounts are affected by the transaction? What's debited and what is credited? Let's say, for example, tools. Let's say for some companies, they might have a question of, should tools be included in repairs expense? If so, tools would be affecting the profitability of that particular company. However, for some types of companies, tools would be included as an asset. It may also be that there would be a dollar value to determine whether something would be classified as an expense and affect the profits, or as an asset and affect the balance sheet. Some companies might say, for instance, all minor expenses or all minor dollar values might be expensed. For instance, say paper clips. Technically speaking, a business might pay for paper clips, and they would be considered an asset of that business. However, most companies would consider that expense to be so minor, that cost to be so minor, that they would just expense that particular item, even though paper clips could technically be held by the company for a long period of time. The cost associated with them is so minor that the business would just record it as an expense instead of including it in its assets. So, what are the 3 issues underlying most accounting measurement decisions, and provide a brief explanation of each. Let's now move to objective number 2 in Chapter 2, Measuring Business Income. In Objective 2, we're going to look at accounts and the chart of accounts. Let's look at the chart of accounts for a business. Business people need some way to be able to organize all the accounts for a particular business. They need to be able to retrieve transaction data quickly and in a usable form. So they've created the chart of accounts, which is like essentially a table of contents for the general ledger, and lists all of the accounts and numbers and names for a particular business. Accounts are basically the storage unit for all accounting data. You can see an example on page 95 and 96. You can see an example of a chart of accounts for a small business. We know from the first semester of this year that our chart of accounts is scalable depending upon the size of the particular business. We know that the accounts should be a concise and descriptive of the accounts that are being used by that business. And we know that the accounts should be listed in the order they appear on the financial statements. So there should be separate accounts for each category, including assets, liabilities, stockholders' equity, revenue, and expenses. A small organization may only have a few accounts, whereas larger multinational types of corporations might require thousands of accounts. The group of company accounts is known as the general ledger, or simply the ledger. In most businesses today, ledgers are maintained in an automated or computerized fashion. Accounts are typically numbered for processing and referencing purposes. The accounts are numbered typically with assets starting with ones, liabilities starting with twos, stockholders' equity starting with threes, revenue starting with fours, and expenses starting with fives. There typically is an allowance for gaps, for flexibility, and changes in the business as it grows. Typically speaking, the order of the different categories is as follows. Assets are listed in liquidity order. Liabilities are listed in order of how quickly they are repaid. And expenses are typically listed in alphabetical order. With regard to the title of the accounts, account titles should be descriptive of that type of account so that it's easily recognizable by those within the business and those examining the business's financial information for investing or borrowing purposes. Let's spend a little bit more time focusing on our basic accounting equation. If we look at our basic accounting equation, we see that our assets equal our liabilities plus stockholders' equity. We've known this since the first semester. If we spend a little bit more time just focusing on the stockholders' equity component of the accounting equation, we can see that our stockholders' equity is broken down into two primary categories, common stock and retained earnings. The common stock of an organization is really the investment by its stockholders. The retained earnings component is comprised of revenues, expenses, and dividends. The revenues and expense items are shown on the income statement, whereas the statement of retained earnings shows all three, revenues minus expenses in the form of profits or losses, as well as dividends. The dividends are shown in the statement of retained earnings as a deduction from the retained earnings of a business. Management needs to keep a detailed breakdown of revenues and expenses for not only budgeting purposes, but also for operating purposes. Accounting gives management information about whether businesses have achieved their primary goals of earning net income by looking at the income statement. Whereas dividends are considered to be outside the normal operations of a business. That is why they are not shown on the income statement. They are shown on the statement of retained earnings. They are basically, in essence, a distribution of the assets of that business, and they reduce the internal value of that business that is maintained in the retained earnings. So let's look at your question for Objective number 2.